bring in Jonathan.
Hi there. Hi, thanks for bringing me in.
Well, good morning, and thanks for doing this. I know we've done it before, but nevertheless, I think it's always important that we just run through what SDCL Energy Efficiency is and what it's trying to achieve. So give you sort of a while to introduce the fund, please, and then we'll dig into questions.
Brilliant. Well, yes, thank you once again for having me on. My name is Jonathan Maxwell. So on the slide that you've got on the screen, I'm on the top left. I set up Sustainable Development Capital, which is what SDCL stands for, 15 years ago. We are the investment manager of SEIT, the SDCL Energy Efficiency Income Trust. I think we've got a few slides that describes the company and the market background and outlook. Just as a very quick overview of what the company does, SEIT, that is SDCL Energy Efficiency Income Trust. It's investing in projects that are designed to help save energy. And we'll come on to exactly how we do that, but there's projects that help save energy on the way to get into where it's used. So very often we generate energy on site for buildings, industry and transport, and save the amount of energy it takes to get energy where it's needed. That's on the supply side. On the demand side, we invest in projects that save energy at the point of use by reducing demand. And then we have a what we call our distribution portfolio, which is we save energy, getting energy where it's needed in the cases that you can't generate it on site. So that's what we mean by efficiency in supply, efficiency in demand, and efficiency in distribution. The portfolio for SEIT is now in gross value around 1.5 billion. It's broadly half in the United States, just over actually, broadly half in continental Europe and the UK. And it's all, and I'll come on to this in some detail in light of the current market conditions, it's all substantially investing in contracted deals, investing in projects where we've got contracts with off-takers over quite a long period of time, 10, 15 years on average, projects which are contracted with end customers to deliver them energy services at effectively a predetermined price or on predetermined terms. In very many cases, with inflation uplift associated with those contracts. So that's where we are. It's designed to be a medium to long-term, robust, contracted strategy. Thank you for going to that slide, and perhaps we'll come back to another one on market background and outlook. But just to sort of give a sense of where things were if we wind the clock back, just over 6 months or so. These are the numbers on the screen that you've put here related to our last financial year, which we reported for the June-July period. The company's shares were designed originally to deliver a relatively high level of income, and then for that income through a dividend to increase progressively. So we've originally at IPO set our target dividend at 5p. We've increased that through 5.5p to 5.62p for the last financial year. And we covered, as you can see, that dividend target of 5.62p, which was declared and paid. We covered that dividend both with earnings and also with cash. And we've had a consistent period over the last 2 or 3 years, since IPO, really, of covering our dividends. So we're pleased with that process, and indeed has accrued some reserves behind that. On the bottom of the chart, you can see some other numbers related to the business to the top down. Set roughly £80 million of worth of profit before tax for the financial year ended the 31st of March 2022. Over £1 billion of net asset value as at the 31st of March 2022, since when we've done another capital raising. And the NAV per share over that period of time had increased year on year from 102 up to 108.4p. We've seen robust performance of our portfolio. If you move on to the next slide, just to sort of give some characteristics of the company, I think it's on slide 5 of the presentation. Yeah. I think the story has continued really since those numbers were produced. We have continue to make investments for the portfolio. We've added to all 3 elements of our portfolio since then, investing over £200 million since the financial year end. Also, since the financial year end, we've raised capital to support our investment program then and in the future, so 135 million at the first half of September 2022, and we thank our shareholders for their support in that process. The company's portfolio today is very largely operational, so over 80% of our investments are in operational assets that generate earnings and cash to contribute to our dividend. And we're very focused, as we always have been, on managing and optimizing those assets so that we can increase margin, increase our revenues, manage our costs, and indeed continue to grow the value of the portfolio. Because the projects are highly focused on long-term contracted income, we are therefore designing our portfolio to deliver a strong and predictable cash yield in terms of the dividend to shareholders. And in fact, we increased our dividend target from 5.62p last year to 6p this year. The portfolio today is well diversified. It's well diversified by credit counterparty. So over £1 billion worth of assets now, well over £1 billion worth of assets, including our debt, about £1.5 billion. So well diversified by credit counterparty, by technology, by sector, by geography, and we have a moderate gearing policy. So we have gearing currently running at about 35% of net asset value. If we just move on to the next slide, just to give a sense of the strategy, and then I would like to zoom out after a couple of slides just back into the beginning here in terms of the market background, but in terms of the strategy, as I said, it's really about supplying energy efficiently, making sure that energy is used efficiently at the point of use, and it's about making sure it gets where it's needed efficiently too. So supply, demand, and distribution are the 3 elements of the Venn diagram here. The real sort of critical mass of the supply side of the SEEIT portfolio over the course of the last 2 or 3 years has been represented by some big projects and portfolios, and we have identified them on this slide at the top left. Onyx, which is a very large solar and storage platform that we own, actually jointly with Blackstone across the United States, that we're adding to. Primary Energy, which delivers heat recovery and waste flue gas recovery, energy recycling, in other words, for the steel industry, concentrated in Indiana and in the north of the United States. It's Primary Energy on the right-hand side, top right-hand side. Actually, I'm speaking from today from SEEIT Oliver, which is a portfolio of 9 projects here in Spain, which generate energy, effectively recycle energy as well here. So that's the supply side of our business. We've added during the period to that supply side portfolio, we acquired substantially all of the renewable energy assets that United Utilities have connected directly to their facilities and buildings across the UK. So we're delighted to have signed and closed that deal now, providing energy services, clean energy services on site, lower cost, lower carbon, more reliable than the grid to United Utilities nationwide. And indeed, we're hoping to add to that through additional projects that we can design and build for them. So really excited to have United Utilities on the client list. We also invested in a project over the financial year in Portugal, which provides on-site generation to the industrial sector here. On the bottom right-hand side, you can see some classic projects we've had: LED lighting, heating, ventilation, air conditioning. We did at IPO, we had already had a very large LED lighting project that helps reduce demand for and therefore the cost of energy inside of all of Santander's buildings nationwide. We've added thousands of contracts now through Future Energy Solutions, which we invested in the United States. And then we've actually added a couple of investments in some very innovative but now proven technologies like variable speed drives that don't use rare earths, with turn tide immersion cooling for data centers with isotopes. So very exciting progress on the demand side. And then, on the distribution side, we've been proud to own Stockholm's gas grid, which happens to be almost entirely a biogas network. So we're taking biogas and distributing that to over 50,000 customers across Stockholm, and indeed working very hard at the moment to get more services and more value and more margin out of that opportunity. Next slide simply just covers off, won't go into too much detail right now, but covers off some more information about some of those newer investments in our portfolio. But if I zoom out on the next slide, as I said at the beginning, broadly just over half actually of our portfolios in the United States, and the rest of it here in Europe and in the UK. Having said that, it's very, very well diversified across the US. We're in every state except Hawaii. In Europe, we've now got investments in the UK and Ireland, in Spain and Portugal, and Sweden, also up there in Iceland, and then we've got a couple of very small projects in Asia within the mix. Just moving on to the next slide, just to sort of summarize a little bit about sort of the diversification. We have split our diversification into individual credit exposures, investment stage, technology, and by country. You can see there on the bottom right-hand side that our exposure to the US is the most significant single sort of part of CH's portfolio today. You can see from the investment stage the emphasis on operating assets, although we do have construction and development assets in the portfolio, which will help with total return and capital gain for that element of the portfolio. By technology, delighted actually now that we've really diversified our technology exposures, lots of really interesting on-site energy creation and energy demand reduction technologies, everything from solar and storage to green gas projects, heat recovery, gas recycling, biomass, ground and air source heat and geothermal applications. So we're really delighted with the expansion of the technology exposure on the top right-hand side. And then on the top left-hand side, you can see a diversified set of exposures to individual projects in the portfolio. But maybe if I could just, with your permission, just take us back a little bit to slide 3 of the presentation. And maybe I'll stop after this. There are some other slides that talk about the ESG components of what we do, but I think I'd like to just frame this within what's going on in the world today. We came into this year with a already really substantial increasing problem with European, UK, in particular energy markets. What was going on? It wasn't very windy last year, gas storage was relatively low, and energy prices catching up with legacy demand rebound from COVID started to increase very substantially at the back end of last year. What's hit us this year with the Russia-Ukraine invasion adds to an already substantial crunch that was going on in the energy market, albeit that the Russia-Ukraine crisis is really a watershed. It's a fundamental handbrake turn in the way that the energy markets are working or not in the European context. So, a huge challenge associated with fundamentally availability and price of energy in Europe. As those challenges increase, another challenge has joined it. In other words, we haven't had much energy available after 40% of Europe's gas came from Russia. The supply crunch that came along with that, the price increase that added to that, was then joined by a third problem, which was, what on earth are we going to do about our climate targets? Because dealing with European energy security has meant figuring out a way of diversifying natural gas supplies, but B, very, very unfortunately, switching back on some pretty nasty fossil fuel technologies like coal. So we've actually seen decarbonisation going backwards this year unfortunately, in practice as Europe has tried to stabilise its grid. So 3 big problems: energy security, energy cost, and carbon emissions. Those are the same 3 problems that SEIT, and indeed SDCL itself, that SEIT was designed originally to help address. All of SEIT's projects are designed to help reduce energy costs, either by getting energy where it's needed, cheaper, cleaner, more reliable, or by saving energy at the point of use. So all of our projects are designed to help reduce energy costs. All of them are designed to help improve the resilience of the energy system, either by generating energy on site, so there's less reliance on the grid, or by reducing, this is a huge point, by reducing the amount of energy that those buildings or industrial transport need, so that you don't need to generate it in the first place. So energy security and resilience is the second key pillar of our strategy. And then the third one, which is maybe the biggest long term, is that the largest, cheapest, quickest source of greenhouse gas emissions is the energy that you don't use. So supplying it more efficiently, reducing the demand for energy is a huge component of our, is a huge component of our carbon emission strategy going forward. In fact, the European Commission now has a policy it's mumbled for years, and now I think is really at the forefront of any of the European Commission thinking. It's called energy efficiency first, because that is really what's going to have the biggest short, medium-term impact on carbon emission, energy costs, and energy security. So with all of that, that's where SEIT is positioned today. It has an existing portfolio that is delivering those benefits for its underlying customers in markets within Europe as well as in the United States. But if we look at all of these macro challenges, which are unbelievably difficult for us all to live through, cost of living crisis, inflation, pressure on corporate margins, fears over energy security, shortages of energy storage, energy price volatility, grid instability, and then this fantastically difficult challenge associated with net zero. All of these challenges come together, to really as the challenges that we were originally looking to see it to help solve. That is to deliver on-site energy that cuts carbon costs and improves security, reduces demand, and I think that's why SEIT is and will continue to be well placed. Energy efficiency as a strategy, reducing the amount of energy we use for the same output. Energy efficiency as a strategy has never been more valuable. So on that note, I shall pause and get into the discussion.
I don't think I disagree with any of that, to be honest. So that's helpful.
Thank you.
I suppose the problem is how do we get it going, really? So first, there's lots of different questions coming in here. I suppose one around just the debt level first. So 35% gearing, is that sort of natural level for the fund? Would you like to be lower, higher?
So we're about our medium-term target. So we're nowhere near our maximum gearing levels. And that medium-term target was set because that's broadly where we would like it to be from a capital efficiency perspective. I should just point out that that 35% is a proportion of net asset value, not of total asset value. So it's not a loan to value ratio. Yeah. And at the moment, all of the debt sits down at project level. And the substantial majority of that debt is project finance, linked and attached to the underlying projects, paid out of the cash flows associated with those projects, and has little or no financing risk depending on which project we're looking at. So it's a relatively prudent and moderate gearing strategy. 35% of NAV broadly relates to about 25% loan to value. So it's really there for capital efficiency rather than to jazz up returns on underlying projects or increase risk. So I think the short answer to that question, sorry to ramble on, is yes, it is more or less where we want it to be. And then we have a capacity to increase our gearing for acquisition finance if that's deemed appropriate.
Yeah, okay. And is that all fixed rate debt or some inflation?
Yeah, almost all of it is fixed rate debt, as I said, secured against the projects to which they relate. There's small elements of shorter term financing, but within the context, nothing substantial from exactly from a top-down perspective. No realistic refinancing challenges for us.
Sure. Okay. Okay. So what's the natural level of gearing of the fund then? So you said 35% is the gearing on the NAV at the moment. Is that sort of like a natural level for the long term?
Yeah, so the medium to long term, well, the medium term gearing target's 35% of NAV. That's where it is. That's the target that's stated. The rationale is, the gearing is really there primarily for capital efficiency. In terms of where it is, currently it's attached to underlying projects. In general, it's fixed term and it's paid for the most part out of free cash flow. So we have very little, if any, exposure to short-term refinancing or interest rate risk. So coming back to the question, the medium-term target is 35%, which is where it is. One point I would make is that it's 35% of NAV, not of total assets. So broadly 350 million of debt across $1 billion of equity, certainly more than $1 billion of equity now, but roughly that number translates into a smaller loan to value. So it's probably a bit closer to 25% loan to value, but that is the medium term gearing target. The company can gear more substantially, for example, for acquisitions, but at this point it's where we expect it should be over the medium term.
And is that kind of fixed rate debt?
Most of it's fixed rate debt at project level, as I said.
Okay, good. So the portfolio, I think it says somewhere is about 85% operational. So what's the balance?
Yes.
Is that in development projects?
Yeah. As you say, I mean, most of the portfolio is operational, and there's an exposure to construction and development, and that gives us the opportunity of creating some additional total return. Up to some 30% of the portfolio could at any time be in construction and development. As it happens, it's much smaller, about 12-13% at the moment. An example of the construction and development exposure would be a portfolio like Onyx Renewables, which we have in the United States. So Onyx does on-site solar and storage. So for example, rooftop solar sort of on the top of car parks connected to buildings, or on the ground connected directly to buildings. You put solar panels and you're selling electricity over time under a power purchase agreement. The bulk of our investments when we acquired them originally with Onyx were operational, but a component of the portfolio is under construction, and yet more projects are coming to a development pipeline, and that's, of course, we are generating some attractive returns in addition to the returns that you'd normally expect to see from operating assets. So that's a good example of where we've got assets under construction and development. As I say, within the portfolio today, it's a relatively small proportion of the portfolio. The bulk of the portfolio is investing in operating assets that are generating earnings and cash and help to cover our dividend.
And when you've got things that are in development or construction, presumably as they become complete and become operational, you actually get to write up the NAV on those. Is that true?
Yeah, I mean, that's the point I made before, was that part of the benefit of having an allocation to construction and development is that it's positive from a total return perspective. I think that one of the reasons. The second sort of additional reason is it's a very interesting area to generate organic pipeline. So we have some projects, for example, our allocation to the EV, the electric vehicle network, where we are building up fast charging infrastructure as a service for very, very big charge point operators who are our customers across the UK, like BP Pulse or ESB. So under those projects, our investment goes into construction. So For example, we're building out fast charging stations like the very big one being built at the moment at the NEC in Birmingham. We take the project to construction completion. We've then got a up to 20-year contract to provide that infrastructure as a service. In that particular case, with NEC to Birmingham to BP Pulse. So that's the benefit to the company. We're able to allocate investment capital to construct assets that can generate long-term income. The real control feature around it is that we are an income trust, so we're looking with that construction and development allocation. As a general rule, we try and invest in assets that can generate an income within a year or so. So it's relatively small projects that can be built quickly with relatively lower levels of risk, so that at least in due course they can contribute to our dividend targets.
Have you got plans to do more of the charging stations?
We made quite a big framework allocation to the electric vehicle network, originally up to 200 million. We've got a first 50 million tranche that we allocated, and it's going very well. So we're very pleased with it. As I say, we've signed a number of sort of major contracts with large charge point operators across the UK, and we want to do more. I think it's very, very suitable and very attractive to see its portfolio.
Of course, anything might change with the government at the moment, and there's all sorts of rumours about what's going on. But how are you affected in the portfolio with the proposed price cap? And does that affect the revenue you get from things like ROCs and FITs already? So
in the UK, which is a very small relative allocation for SEEIT within its overall portfolio, but within the UK, we have I'd say three types of projects that provide electricity, projects that provide heat, sometimes both, and then projects that provide other types of energy services. So the energy price cap you're referring to, I think, would really relate to the first bucket, that is energy projects that provide electricity. The difference with our projects in the UK is that we're providing those energy services not to the grid, either for market returns or for ROCs or for CFD income, but instead providing those electrical services as power under power purchase agreements directly to end users. So the payment that we get back under those contracts is the contracted level that we've agreed with those end customers. So they are a bilateral private contract. So as such, the energy price cap in itself, which of course is a feature for generators, particularly with exposure to the grid or to market incentives potentially, certainly don't apply to anything like the same extent, if at all, frankly, to see it in the UK. So the first point on electricity. On heat, we're providing heat services, again, under similar contractual arrangements directly with end customers. We've got a limited amount of exposure to the renewable heat incentive, but again, that's there not, it's nothing to do with providing electricity to end customers. And in that particular case, it's all about providing heat services to industry. So again, should have little or no impact. And then I think the third area is, other forms of energy efficiency project across the UK. And again, in that particular exposure, sort of, again, frankly, has nothing to do with, at all with the energy price cap. So in the UK, our exposure is limited, and in any case, the energy price cap does not apply to a substantial degree, if at all, to our projects here.
Are you concerned about the sort of political will to get this energy efficiency stuff built?
So I would like to see more energy efficiency higher up the agenda for politics in general. It's a huge problem. The problem I'm pointing to is that so much energy is lost in the system through conversion, generation, transmission, and distribution. So much that in countries like most European countries and in the United States, most energy has been lost before it even gets to where it is needed. And that's a feature of a centralized energy network. Now, there are no silver bullets, but investing in decentralized energy, bringing energy generation close to or right to the point of use, eliminates a vast amount of that loss. So it makes huge sense at a time when availability of energy is scarce, when prices are very high, that we start to, from a policy perspective, incentivize on-site or near-site generation, because it's a huge solution to the problem. Here we are fighting over energy, quite literally, when Europe's wasting most of it. So from a policy perspective, to me, it makes all the sense in the world to focus as much on decentralization of energy as on new clean energy generation. We're all in favor of building out new clean energy generation capacity as quickly as possible for the grid, but if so much energy is being wasted, at the same time, we have to invest in solutions to that problem. So policymakers must focus on decentralization as part of the story. The other thing that policymakers must do is focus on the amount of energy that's wasted at the point of use. And I think this is a big problem. Buildings typically can waste 10, 20, 30% of the energy that they use just because they don't have the right lights or the right heating, ventilation, air conditioning. Those are solvable problems by investing in the types of solutions that SEEIT invests in: LED lighting, heating, ventilation, air conditioning systems, building management systems and controls. So these are solvable problems. Again, no silver bullets, but at the same time, as governments are looking at how they should add new energy to the mix, they should also be looking at how they reduce energy. And I'd say that it's no less important. The same, if not more, emphasis should be placed by policymakers. Is it? Well, in Europe, yes, it is actually to some degree. So Ursula von der Leyen's mandates is energy reduction, so 15% less gas, she told European member states they have to use now, 5% yet less electricity. Energy efficiency first is a mantra. So European Commission is now responding to go onto the demand side and say you have to reduce the amount of energy that you use. And I think the UK of energy policy, I think, to put it mildly, is under review at the moment. And when it comes out of review, I very strongly will be arguing and explaining why we should be emphasizing energy efficiency. I don't mean to reduce the amount of product or output we create, but actually to improve productivity, to generate a better solution. Use less energy for the same level of economic output. We can, because we're wasting so much of it.
Fair enough. Thank you. We talked about the impacts of higher interest rates. What about inflation? How does that affect the portfolio?
Inflation affects our project investments in different ways in different countries, and depending on the contractual circumstances of individual projects. But as a general rule, in the important accounts ended 31st of March, we gave a sensitivity for inflation, and we showed that as a general rule across the portfolio, inflation is a driver of our revenue. It is also a driver of our cost base, but net, we are positively correlated to inflation. So higher levels of inflation will lead to higher levels of overall revenue and profitability and NAV. However, inflation, I think, is welcome by anybody. I think it's extremely important that it's got under control, and of course that is going to be the huge emphasis for central banks and policymakers over the next year or two to do that. It's also one other point that relates to the energy sector. Let's look at where inflation is coming from. Inflation has been largely fueled in Europe by energy. So again, there's a very, very strong link between our business, which is about investing in energy savings, which is incredibly valuable in our high energy price environment. Very high relationship between that and inflation in general. So while policymakers and central banks are going to be looking to attack inflation, we're looking to attack it in a slightly different way, which is doing more business in the energy efficiency sector. But overall, we're net positively correlated.
Okay, thank you. It's an incredibly broad portfolio. There's so many different strands to it. How are you actually sourcing these projects?
So just to follow up on that question, yes, it is a broad portfolio because the range of solutions for the problem that we're trying to deal with are quite broad, and that's a good thing. The problem that we're trying to solve with all of our projects is singular. That so much energy is wasted, and that there are solutions. All of our solutions involve using less in one way, shape, or form. So yes, there are a number of good news. There's a number of ways to do that on the supply side, on the demand side, on the distribution side. To answer your question, how do we source deals? We're investing in projects that we are from scratch, for example, like the electric vehicle network, where we identify our partner and then we work with them to go out and develop projects for end customers. We've acquired projects from existing investors, from utilities, from equipment manufacturers. We've just done this deal with United Utilities. We've acquired the portfolio from them. It was their on-site energy system for the UK, and we've acquired that substantially whole in order to provide energy services back to them. So there's quite a variety of ways in which we acquire existing assets. In one or two cases, we've acquired platforms from other from their original shareholders, sometimes from private equity. So it's quite broad, but I would say, just to summarise it, it's probably three sources to see it. The first one is directly engaging with end customers, end users of energy, and solving their problems. The second, is working with partners like EBN or like other developers, utilities, equipment manufacturers. And then the third is, really through acquisition, where the existing shareholders might be an industrial group. We did that with Sacyr here in Spain. We've done it with, in partnership actually now with Sonae Capital in Portugal. We've acquired from one or two private equity infrastructure, capital gains oriented players. So it's quite a broad range. So, sort of direct, strategic, and then financial counterparties.
And you've just raised 135 million. How long is it going to take to invest that? Well,
we've always got organic pipeline, and I think that's one of the things that we've described consistently over the last year or two, because SEEIT's portfolio has got to a scale. There's a critical mass. A number of our projects come up to us, off the back of existing investments that we've already made. So, I've already explained two good case studies of that: the electric vehicle network that demands more capital for new projects for its customer base, Onyx Renewables in the United States, for example, where we're not just owning operating assets, but also creating new ones. So we've got quite a substantial organic pipeline. We've also got potential acquisition opportunities, which of course, in the current market environment, we would be, mindful of, about value and so on. And then, of course, we've got, the overall financial position of SEEIT to look at as well. So we'll always look at protecting, positions that we've taken, enhancing investment. So the 135 million we've raised is well spoken for, frankly, even to our organic pipeline. If we do see opportunities for new secondary market investments or acquisition, we can do that as part of the 135 million or through the acquisition financing facilities that we have available to us under our debt, under our revolving credit arrangements. So the company is in very good shape to protect its existing investments, to invest in organic pipeline, and if we see something that we like in the market, to step in and buy it.
Okay, cool. I suppose you've alluded to. Do you think that discount rates are effectively going up across the board, or is it sort of a case-by-case thing?
Look, I think there are. It's a fact of life that long-term government borrowing and long-term corporate credit costs have gone up. Having said that, by different measures in different markets and at different points of the yield curve. So if I look at our portfolio, I would be thinking harder about, for example, long-term, medium to long-term rates and borrowing costs for corporates in the United States. That's really going to be the sort of the first port of call. We'll be looking at, what type of revenue we've got, what type of term we're contracted under. So, I would say that different markets have responded in different ways in terms of interest rates. Having said that, our general approach has been to invest for slightly higher levels of return than some of the peer group focused on more sort of core core infrastructure in the past. So our discount rates usually been somewhere in the middle to the higher end of the range of comparable discount rates. We've not tried to be aggressive in the past with how we've taken our discount rates. We've got an independent party that looks at them. We've wanted to keep, again, well within the range and certainly not at the bottom of the range. So, I think we've taken a prudent approach in the past. We're certainly going to have to take very careful note of interest rate movements, but we'll be doing that in local markets, at the maturities that relate to our projects, and also bearing in mind, I think the other side of this, of course, is that bearing in mind that there are also other features which are drivers of value for us in very, very challenging market conditions. You mentioned inflation, but of course the energy market in general being a higher priced environment, for a business that's fundamentally involved in supplying energy, lower cost, lower carbon, more reliable than the grid, but nonetheless in a higher price environment. And of course, the value of the savings that we generate is higher than it's been before. So definitely headwinds to look out for in terms of interest rate movements, but quite a few tailwinds behind our business, which, as I say, fundamentally has been set up to solve some of the biggest problems that we're facing today: cost, energy security, and decarbonisation.
Cool. I think that's really helpful. Thanks, Jonathan. I think we should maybe wrap it up there. But it's good. Always good to hear from you, because it's good, sort of nice wrap up around the world as what's been going on in terms of renewables and energy efficiency stuff. So
yeah,
thank you.
Well, great. Thank you so much for taking your time to have me on, and thank you for tolerating the technical challenges.
Well, yeah, that's not a problem at all. Good. So thanks very much, Jonathan. And we'll be back next week as usual, and we'll be talking to Ross Driver, who's the manager of Foresight Solar Fund. It should be an interesting conversation. Hopefully we'll have some more clarity on what's going on with UK energy markets by that stage. Maybe even have that this afternoon, we never know. The other thing I want to highlight on this is the upcoming London Investor Show on the 27th of October, and the same place in the following days, the AIC Investment Company Showcase. So they've got a bunch of different managers presenting to retail investors there. And the event details are all on our website. Please do have a look, but we are helping them to organise it. So it would be great if some of you do come along. So thanks very much, and we'll be back again next week. Thanks, bye-bye.